I think the one sector that'll be a dead giveaway if the West does turn Japanese, heaven forbid, is the banks. Because if you look at the Japanese banks, they're down 90% from the market peak in 1989, and they've slavishly followed a flattening yield curve all the way down. So with Japan having employed negative, zero interest rate policies for most of the last 25 years, if the UK or the US or Europe gets trapped into the same situation, that would show up in the yield curve, it would show up in credit spreads, as well as interest rates, and banks need positive rates, wide credit spreads, and an upward curving yield curve. They haven't got that right now. That's where they've underperformed. So if that persists, banks will probably still struggle. If it changes and the world becomes different, banks will therefore be one of the first places you'll see it as well. For the global economy, two great indicators: Dr. Copper, reflective of the world's health, and transportation stocks, because if goods are being sold, stocks have to be moved around and replenished. So those are two good indicators economically speaking. Right now, they're doing okay, but they're not doing brilliantly. In terms of market reflections of that, look at semiconductor stocks, look at small cap stocks, look at bank stocks. Chip stocks are doing well, banks not well at all, and the small caps somewhere in the middle. They'd be your quick, simple 5 indicators to growth, no growth, inflation, deflation, and risk on, risk off. And at the moment, chips are looking really good, banks are looking really bad, the other 3 are somewhere in the middle. It's always dangerous to it's tempting but dangerous to extrapolate your experiences from the past decade to the next one. It's what we remember the most, it's what we feel right now, and it's very tempting to think, well, this is going to keep on going. But if you look at in 1990, at the start of 1990, the world's biggest stocks were nearly all Japanese. Start of the 2000s, they were nearly all tech. Start of the 2010s, nearly all commodity players or China players, because they'd done brilliantly in the previous decade. But if you look at then what happened, they didn't perform well in the next decade. So right now, the world's 7 biggest stocks by market cap are all tech stocks. That's never happened before. I'm not saying they're going to blow up, but I'm just saying that relatively, is it really going to be as good this decade as it is the last decade? History would suggest not, but I must accept that the past is no guarantee for the future. The bubble of everything concept, I think, is legitimate, because it's not just stocks and bonds that have gone up. Art, wine, vintage cars, rifles, shotguns, second-hand books, they've all done incredibly well. The theory being low interest rates or negative interest rates are forced cash to look for a home someplace else. So you can easily argue it. Sotheby's used to be a brilliant way of tracking that. The stock, BID, was its ticker on the New York Stock Exchange. And if you think about it, it was a logical place to look because they auction all this stuff off, right? Problem now is Sotheby's is taken private, so we can't use that as a check. So what I'm looking at, for example, is a little stock in a little Arkansas bank called Bank OZK. Some hedge fund friends have said keep an eye on this because it's very heavily exposed, particularly to Florida and Miami real estate. Now, I'm not saying that's a perfect proxy for the bubble of everything, but you would think that if Florida real estate starts to soften a little bit, Miami real estate, maybe that's reflecting that other asset classes will do. And if you look at any bear market, trouble starts in peripheral areas and moves slowly towards the core being equities and bonds. Periphery, you could argue that cryptocurrencies are already gone, for example. Maybe property could be next. Let's see. Let's just keep an eye on it. I'm not saying it's a fail-safe, but if property-related banks start to struggle, that could be a potential dangerous sign. Equally, if we are in a all health leather growth environment when inflation starts to pick up, they're probably the areas where you want to be.